Hello, welcome to our June edition of our monthly 5 in 5 video series. I'm here again with Mitch Healy, our investment analyst from AZ Sestante, to walk through what's happened in the portfolios, how we see things moving forward, and what are the key insights that's happened in the past month. Also, for future editions, we would love to get your feedback, and if there's any questions you want to hear or anything you want to hear from Mitch and the team, please send an email to invest@azsestante.com. As we begin, so Mitch, thanks for joining us again. May was yet another busy month for markets. What were the key insights from May?
Sure, AV. So March saw a strong rebound in share markets despite ongoing global uncertainty. Now, the US held interest rates steady, but investors are now expecting cuts later this year, especially as that economic data continues to soften. Now, inflation's still a concern, but it is showing signs of gradually easing. Globally, equities rallied, and it was led by tech and healthcare, particularly in the US. Europe and emerging markets also performed well, particularly as those trade tensions begun to cool, with some of those tariffs delayed. Now, inversely, bond markets are actually a little bit more volatile, especially in the US, where government debt concerns started to trigger a mid-month sell-off. Now, whilst uncertainty remains, markets responded really positively to signs of stabilisation, backed by strong corporate earnings.
So Mitch, we hear a lot about Donald Trump's big, beautiful bill. Can you give us any insights on how it's impacted our portfolios in the month of May?
So AV, President Trump's big, beautiful bill is a government spending plan, which is over $2 trillion, and it's really aimed at cutting taxes, increasing defence and infrastructure spend, and giving some relief to households through things like tax-free tips and bigger family tax credits. Now, whilst it sounds like a boost for the economy, it also raises a big risk: more government debt and the chance of inflation picking up. Now, importantly, if inflation rises again, interest rates may have to stay higher for longer, and that's something we're watching closely in the investment committee. Now, in terms of our portfolios, we're currently overweight Australian fixed interest, which is more insulated from what's happening in the US. However, inversely, in global fixed income, we've started to look at reducing our reliance, particularly on longer-term bonds, which can be more sensitive if yields continue to rise. So whilst we haven't made any big changes yet, we're preparing for a range of outcomes, and we're continuing to manage risk carefully as the situation evolves.
So Mitch, with that backdrop, how are our portfolios positioned?
So overall, we still have a slight tilt towards growth assets. Now, we think there are opportunities out there, even with the uncertainty. Within US equities, we remain underweight, where we think valuations are still quite high, and particularly when policy risks are evolving. Now, we prefer Europe at the moment, where we see better value and improving earnings. We're more or less neutral on emerging markets, and we're underweight Australian equities right now. Inversely, in the defensive part of our portfolios, we continue to favour Australian fixed interest. The RBA is on the path of rate cuts, and this supports really a backdrop for local bonds improving. We're also staying focused on higher quality exposures across the board. We want resilience, not just return. And importantly, we're keeping portfolios pretty well diversified. Now, that includes a healthy allocation to real assets, things like listed property and infrastructure, where we think they offer good defensive characteristics whilst this period of uncertainty plays out.
So Mitch, who are our top performers and key holdings within the portfolios?
So AV, May was a strong month for equities, with several of our key managers delivering solid results after a volatile April. Brown Advisory led the way, closing the month up nearly 6%, driven by its focus on quality and lower US exposure. T. Rowe Price's Global Equity Fund also outperformed slightly, benefiting from broad-based market strength. Inversely, in Australian equities, performance was positive overall, with Yarra X20 outperforming the large cap benchmark, a pleasing result following our increased allocation back in February. On the fixed income side, Aussie bonds closed modestly higher, with most managers adding some value above the benchmark. Global fixed income dipped slightly due to the volatility mid-month, but again, our managers generally outperformed their benchmarks through active positioning. Overall, AV, we came away in May generally pleased. A strong month with positive contributions from most of our asset classes.
And so Mitch, like every month, let's get that crystal ball. How are things going to be positioned for June?
So looking ahead, AV, we expect markets to remain a little bit choppy as investors continue to digest the impacts of US fiscal policy and ongoing tariff uncertainty. While some of the trade tensions have eased, risks could flare up again. We're also keeping a close eye on inflation trends and central bank signals. Now, if economic data continues to soften, we may see more support for rate cuts, which could benefit both equities and bonds. However, inflation proves stickier than expected, especially in the US. That could put upward pressure on yields again. Overall, we think a balanced and diversified approach remains key. We're seeing pockets of opportunity globally, but with volatility likely to persist, it's important to stay nimble and focused on quality.
Thanks once again for joining us for our monthly edition of our 5 in 5. As I previously mentioned, if you have any questions or whatsoever that you'd love answered for our next editions, please send an email to invest@azsestante.com. Thank you and see you next month.